Boom to bust, Wall Street and the FTX aftermath. We've got a great panel. VanEck from VanEck Funds. Come on out. Eric Donovan from StoneX Group. And the moderator is going to be Dan Opre from Bakkt. Let's give him a hand. Thanks.
Hey everyone, good morning. Welcome. A pleasure to moderate the opening panel here at Bitcoin Miami. And have great guests, distinguished guests to kick everything off. So I think starting with, a lot has changed since we were here last year. Luna still existed then. Since then, we've seen the dramatic implosions of multiple crypto companies and more recently banks. Starting with Luna, Three Arrows, Celsius, and culminating really in FTX late last year in a matter of days. Since then, we've seen a banking crisis in the US with multiple banks go under. So a lot has changed since last year. A lot is different, and would really like to kick off with Jan and Eric to understand sort of how are institutions dealing with the effect. How has it changed their approach to looking at Bitcoin?
I'll take that one, Jan. So one of the biggest things that we're seeing now is a flight to quality. I think especially for those in the institutional space where credit risk obviously becoming a huge concern, operational risk. So there's two things that we see with a flight to quality. One is a move towards counterparties and players that are reputable and well known. So I think there's, someone correct me, but you can't even count how many Bitcoin exchanges or digital asset exchanges there are globally. The number changes week to week. The bottom of the barrel are kind of really getting squeezed out right now, because if it can happen to FTX, what about that no-name offshore shop that you're trading on? People are scared. So there's a flight to quality, but I would also say even more so with the type of coins that are out there. Bitcoin is the clear winner over the last couple months. You can see it in the price appreciation. But we as a firm made a decision that it's Bitcoin only. Because it's trusted, it's known. So, both in the type of digital assets that people are gravitating towards, as well as the type of players that they're willing to deal with, that's the move that we've seen.
Oh, a lot of things have changed in the last year, obviously, but just for those of you who don't know VanEck, just a quick intro. We started, I feel like I'm at home here. We started the first gold fund in the United States in 1968. And what I'd like to remind Bitcoiners is, when my dad started that fund, he wanted to hedge against the risk of government money supply and government spending, and gold had been fixed at dollars, not just for a year, 10 years, but for the entirety of US history. So as a historian, the world can change really fast, and Bitcoin is a great thing to look at in people's portfolios, and we approach that philosophically for a long time. The first thing I would start with in looking at the last year is just looking at the underlying technology, and I think the last couple of months have been really good, because the concern is always the economics of the validation of Bitcoin, and the fact that transaction fees have risen from 5% to 30% for the people involved in the ecosystem. I think shows that when this halvening cycle stops in many decades from now, that the ecosystem may continue. So that's the big thing. Now, as far as institutional investors are concerned, there hasn't been that big a change. I think what I like to say is institutions, you have to break out into different categories. Macro hedge funds are still involved in Bitcoin. They still trade Bitcoin. They still are believers. They still are actively involved. The vast majority of institutions have never been involved. Right? The typical US institution maybe owned some Andreessen Horowitz and got involved in tokens through that VC allocation. In general, institutions are way over allocated to private equity and VC, so I don't really hold out a lot of hope for them anyway. And then there's in the middle between the maxis and the kind of probably never get involved are the persuadables, and the persuadables are hanging around. I would have guessed people don't show up at conferences this year or whatnot. They're still very engaged. They're still trying to understand how to get involved and when. Obviously, they're a little concerned about the price collapse and FTX and the regulatory FUD.
And do you think institutions generally appreciate the distinction between Bitcoin and, which wasn't really at fault for most of the collapses that we've seen in the crypto space. Some of the different crypto activities, the lending, the business models, exchange tokens. Is there an appreciation with institutions of a difference between Bitcoin and crypto, or do they see it still as sort of one large singular asset class?
It's a good question. I mean, I think generally, especially by the traditional institutional community, it's still sort of viewed as one big asset class. But, one distinction I would make is that if you look at some of the bank failures, Signature, Silvergate, they were known as some of the only banks that were at least somewhat friendly to the industry, that would provide banking services to custodians and exchanges. And I think that, they went under. Did they go under because of anything to do with Bitcoin? Well, the answer is no. They actually went under because they didn't manage their interest rate risk exposure appropriately. So it's sort of like an irony that the banks that went under, the reason they went under had almost nothing to do with digital assets or Bitcoin, and I think there is a recognition of that. But yeah, I think in the traditional community, there's still this sort of like, it's just this one big thing over here to some extent.
Like a lot of investors don't even believe in gold. Warren Buffett makes fun of crypto, but he also makes fun of gold because it's not an income-producing asset. So it's a small subset of institutions that are involved in gold. Obviously, central banks are hugely involved in gold. As part of this de-dollarization that has accelerated dramatically in 2022 and now so far in 2023. What I would say is, so you look at like Texas Teachers or Alaska Pension Fund, like people that might have held gold bullion in the past are definitely open to Bitcoin, but there's a lot of people that aren't. So that's what kind of how I see things going right now.
Great. And obviously, other than the bankruptcies, the disruption, the price changes, what really has changed, or perhaps what should change in the industry, in the market structure of the space? In traditional finance, they like to joke, sort of crypto bros are relearning many of the lessons that finance already knew. Are there any lessons that we should be learning in terms of market structure approach that can really help accelerate institutional adoption, or any asset classes that we should be looking at to imitate?
Go ahead.
Well, I mean, I certainly think so. And, there tends to be a little bit of a hesitation towards any sort of derivatives on Bitcoin. And I understand that. It's not true to what the intent of the asset is. That said, we're in regulatory purgatory, so to speak. I mean, there's no clarity for institutions. So when you have, funds, banks, payments providers, there's no certainty. So it's really difficult to invest in, building out various capabilities when you don't know. It's year 3 now that we're waiting for some sort of regulatory action from the CFTC and the SEC, and we just don't get it. So there's no clarity. So because of that, swaps play an important role in my view. Swaps are regulated under the Commodity Exchange Act, and you can trade swaps on Bitcoin, the same way that you can trade swaps on energy or interest rates or whatever else. And so this sort of opens the door. And I think that this is sort of like an important role where institutions can get involved, even if they're prohibited, either directly prohibited or indirectly, because they're not comfortable with the risk and the regulatory risk. So, that's one area where I think that there's a huge potential right now, is just in the derivative space, because that's what gets institutions involved. That's what opens the door to a massive amount of participants, which increases liquidity and increases, the turnover in the ecosystem, which is generally a good thing.
Well, I think industry players are global in nature. VanEck, we manage about 70 billion, and we have 20% or more of our assets, domiciled outside the United States. 80% of our crypto funds, so we offer ETNs that wrap tokens or multiple tokens in Europe. We have 12 of those. Maybe we're a top 5 or 10 crypto manager. 80% of those assets are in Europe. And we're moving, I think Europe is going to be the winner here. We just made that strategic decision in the last 2 to 3 weeks, because we have to interface with a regulator that can say we like this or we don't like this. Just to operate in the United States, we're not getting any guidance whatsoever. You can go jurisdiction shopping. You can go to Singapore, Brazil, UAE, whatever, but then Bermuda, and I think those are all legitimate financial centers, but really, do they have a lot of retail presence? Like if you win the license, what do you really win? And so I think that Europe, Germany's approved all of our ETNs, France, these are mainstream retail markets that to me are the most promising. So we'll see how MiCA gets implemented, starts in January of next year, but I think you want to work with a regulator. As an institution, we're both regulated. Regulation has been great for the mutual fund industry, the ETF industry. So, I think that's where we're going.
Great, and I'm sure we'll touch a lot more on regulation, and will be a big theme of today. And Eric, you mentioned derivatives, and Jan, obviously with ETFs. A lot of people here may be, on the sort of not your keys, not your coins, self-custody side, and a lot of interest in spot and holding the physical underlying. Can you maybe just help share to the audience a little bit on how these financial products help institutional adoption, and perhaps what knock-on effects that will have to Bitcoin and the retail space generally?
Sure. I mean, so if you look at other asset classes as sort of a guidepost here, I think you can look at metals, you can look at obviously fiat foreign exchange, where you have all different types of ways. And if you think about what it would take if you were just pick any sort of bland institution. It doesn't even need to be a fund, but where your core business, 98% of your revenues are trading in some other sort of asset, not Bitcoin. And you say, you know what, we want to allocate 5% of our assets to Bitcoin and really get involved in the market. Well, that's a really hard thing to do. You might be regulated as an Act 40 fund in the US. There's just a whole host of things. Your banking partner might say, no way. I mean, this is a huge problem for the industry, where especially now that some of the Bitcoin friendly banks are no longer with us, it's really, really hard to get banking services, even if you can get, basic US dollar banking services. Getting multi-currency accounts, like this is becoming increasingly difficult for the industry. So I think that this is where having access to alternative products, yes, you have credit risk to your counterparty. It's not the same thing. You would never tell somebody who is, trying to invest and save for, the future, that's investing in Bitcoin. Yeah, you know what? Get a wallet and own your key, for sure. However, there's a lot of liquidity that comes into the market on fiat assets currently. And so to have a fiat Bitcoin that allows, potentially, exponential increase in the number of participants, this is good. I mean, if you go to any Bitcoin exchange and look at the bid-ask spread, the price at which you can buy and the price at which you can sell. Compare that to other assets that have a robust physical market as well as derivative market. I mean, look at the price in most currencies. It's like the bid-ask spread is like $10, $20 wide per million. And then you go and you look at Bitcoin, even if you have access to every exchange, the market's really wide. So having that liquidity, having market makers that are constantly trading the physical, the futures, the swap, cash settled physical, this is how liquidity comes into the market, and it makes transaction costs drastically reduced. So I think that's the core benefit, is that it just rapidly increases both acceptance as well as liquidity, which are two critical things.
I'd say two very different things. Number one, I think because of FTX, we know that exchanges and market makers should be separate. Everyone knew, people were like, oh, I'm so surprised that Alameda was trading with FTX. I'm like, you obviously were paying no attention whatsoever, right? Everyone knew that, and actually, same with Binance, it was a plus because investors go to where the liquidity is. So having said all that, like we all knew it was happening, but after this, people are going to want that. I believe in the industry, we should advocate for separation of market making and exchanges. Okay, totally separate point. Also, post FTX, we need, self-custody is a part of the future. And I think a big part of the future. And how do we get there? We obviously have to make the wallets easier to use. They have to be more mobile friendly. I think the Solana phone is, oops, I don't know if I'm allowed to say that word, but devices like that are really good. And then I think I'm really excited by some companies that are bridging, I'll call it the TradFi world, with visibility into self-custodial wallets. So if you can bring your holdings all together into one view, I think that's great. And that it solves this whole custody problem, because we may not have a custody solution, regulated, approved custody solution in the United States until the next administration, right? The FCC has, proposed qualified custodian rules, but no company may want to comply with them because of capital requirements. So it could be that so that's why I think self-custody is part of the future, and just like live with it, right? Have the tools to bridge the two worlds.
Yeah, and with that market structure point, do you see it going more like the sort of traditional equities world with that separation of exchange, custody, broker-dealer, or more like the FX world where it's maybe a little bit more off exchange? And how is the implosion of FTX sort of driving that one way or the other?
I mean, FTX was one of the largest exchanges, and we saw what happened there. So I personally have a bias towards a non-exchange world. I don't see the value of having exchange choke points. And to your point, self-custody is one of the ways that we get there, where you just don't need exchanges. There's, in the FX world, we have this concept of ECNs, which is electronic communication networks, where counterparties can come and get involved, but it's free access. You can get turned away. And the foreign exchange world is extremely complex. It's extremely decentralized. There's no one price at any given moment in time. Transactions are taking place between bilateral counterparties on their own free will. They're taking place on exchanges. They're taking place in the derivatives markets. There's some to some marketplaces, all to all marketplaces. It's happening all over. And by having no choke point, the system is extremely robust. You've never seen the foreign currency system fail in any of these crises that we've had, because it's extremely robust. Even when with the Russia-Ukraine crisis, it was still possible to trade Russian ruble for an extended period of time, even when every major government in the world said sanctions, no more Russian ruble trading. It still trades, and it actually still does to some extent. So I think that sort of decentralized model is what probably works best in the future for Bitcoin. The problem is it's unregulated, and that's where you kind of run into a wall, I think, with regulation.
I'm glad I can finally disagree with you about something. So I don't disagree that a decentralized market is more robust, more resilient. I completely agree with you on that. But the beauty of an exchange is, and I'm an ETF issuer, so of course I'm going to say that, is you provide transparency to the underlying product. You can see how it trades. You know every day what's underlying that, that ETF. And I think that's brought a lot of individual investors, confidence to access that investment. And I think that's that's the problem with these, CFIs, centralized exchanges, is they're not sufficiently regulated, and the price discovery is not spectacular, to your point, but it holds the market back structurally, because individuals just don't see, oh, what is the price? You know the price, because you're seeing millions of stuff trade on your balance sheet, right? But the individual investor wants to see what that is, and they want to see things trade a penny wide, right? So that's the point I would make, is you may miss part of the retail investor, if it's too decentralized and there's not a clear point of price discovery.
But that's where ETFs play an important role, I think, in this paradigm, where ETFs are a derivative. And yes, they trade on an exchange, but they trade on an equity exchange, right? So it's sort of a different thing, where this plays an important role in the market, where, okay, I can trade Bitcoin without having to navigate the decentralized marketplace by trading an ETF, and maybe it's not the same thing, but I gain that exposure. That serves a pretty valid purpose in the marketplace. But I think that's a lot different from saying, we see a future where all physical transactions are taking place on centralized exchanges. So it's a subtle difference, but I think it's an important one.
Okay, fair.
Always good to have some disagreement and debate, so that's good. And so, on the regulatory point, I think we're going to talk on the panel after this about the actions that the Fed and the OCC have taken and sort of Operation Choke Point 2.0, as we've seen. The US is particularly challenging in the, in the best of times, or in most markets, with the local, state, federal regulators and different entities with different jurisdictions. Bitcoin and crypto obviously has been a particularly challenging place, particularly for the SEC and CFTC, who oversee exchange-traded products versus the commodities and derivatives. Where do how much is that holding institutional adoption back from Bitcoin and Bitcoin products today? Are we getting any closer? Jan, you mentioned earlier potentially Europe being a winner out of this with maybe more clear framework. Where does that stand in the US, and what do we need for institutions to really jump in?
Yeah, so let's talk about the US for a second, and let me sort of see how I explain how I see things happening. So first of all, I'm an informal advisor to New York State crypto regulator, and that would make me a worse human being for several people I know in this audience. So I don't endorse what they do, but I don't think they clearly explain what is happening in New York State. So to get a bit license used to be a choke point. It would take 18 months, seen as a big negative for the industry. However, I would argue they are standing up one of the world's best crypto regulators right now. They have 58 people, full-time, dedicated crypto. They're very knowledgeable. All the major exchanges in the United States have a bit license. They do on-site inspections. They ask for things regarding the, not just are your customers drug smugglers or something, but also have they been doing rug pulls every week? So they really want to bring some cleanliness into the market. And they, on the financial disclosure side, they require not just proof that you have the customer assets, but they look at the entire balance sheet of the custodian, which everyone knows under FTX that was an important thing to look at as well. So, they're engaging a lot with regulators around the world to set best standards. So I joke to them that you're building the perfect regulator in an industry that's illegal, right? So whether that matters or not, I'll tell you why I think it might matter. In the United States, we have a huge part of the financial services industry that's not regulated out of Washington, and that's the insurance industry. So it literally could be, and I will, let me give you a thought experiment. What if Florida stands up and a similar kind of crypto regulator to the DFS? So you have two robust state regulators, knowledgeable, trying to work with the industry to grow it responsibly, one in a red state, one in a blue state. If Washington can't agree on legislation, you may have regulation at the state level. With maybe some guidance from Washington that they'll stay out of the way. So anyway, so that's kind of a future that I think is possible. It's low odds, but it's to some extent it's happening in New York.
I think I totally agreed. I think the choke point there is for firms that are in multiple asset classes, because I agree, New York State has been solid. Definitely the best regulator to deal with right now on digital assets. The problem is if you were going to go at it from where we are Bitcoin only or digital assets only, we don't touch equities, we don't touch futures, we don't touch commodities, we don't touch anything else, right? We don't touch banking. We're just all in. We're either a custodian or a broker. Then that is a viable path. The problem we have now, though, is that I'll give you an example. So in addition to our institutional fiat business, we own Forex.com, which is the largest retail foreign exchange marketplace in North America. So Forex.com is in the process of hopefully launching a Bitcoin product, a physical Bitcoin product that can trade through, through our systems. And we're able to go through the state licensure and get to where we need to be. The problem is that we're also a retail Forex dealer. So we also have to deal with the NFA that has 10 million more questions than what the New York State regulator had, even though it's not a retail Forex transaction, it's a physical Bitcoin transaction. Then let's flow up to our parent company, SEC regulated Fortune 500 company. So there's so many layers of regulation unless you're a purist. So if you're in multi-asset classes, this sort of like just nobody knows what the rules are on a federal level. It's just, it's exhausting.
Yeah, that's why I snuck in there. We need some kind of guidance from Washington just to let the states do it, totally. And I realize that's easy to say and very hard to do, but we have,
it's possible.
I think, some presidential candidates that are going to be at this conference. And that's not a big lift. Just say, okay, if it's regulated at the state level, defer to the states, right? With some minimum standards. They don't have to, have some love fest between the SEC and the CFTC, which will never happen in our lifetimes, right? Just push it off to the states. I don't know if they have any interest in that whatsoever, but we'll see. But you're right, it has
be the
to
best
happen
outcome.
because DC is killing everything else.
Yeah.
And that's why I say the DFS is building the perfect regulator in the legal industry.
I mean, I'll take it a step further and say that it really, at this point in time, 2023, it's pretty obvious that the federal government in general, it's not that they're just dragging their feet, they actively don't want to have any clarity because I think they just don't want to deal with it, and it's a political thing too. I mean, how many people either generally are Bitcoin enthusiasts or they just don't care and don't understand it? And that's probably the majority, is don't care, don't understand it, right? I don't know a lot of people that are like fervent, foaming at the mouth, I hate Bitcoin, right? That's not super common. And so if you think about this from a political standpoint, no politician gains anything by taking a really hard line against Bitcoin or digital assets in general. And some do, for sure, but it's sort of like, it's not a winning political platform. That said, we as a country, the US dollar is the world's reserve currency. And so, inside the halls of power in DC, anything that's a challenge to that is a real problem for those that are in power. So I think that, we talked about the concept of shadow banning, right? I think we're in regulatory shadow banning right now, where Washington just wants to sit on their hands and not deal with it because it's a political loser for them, while at the same time, the halls of power have to protect the sanctity of the US dollar, which is outside their control, really.
Certainly, yeah, extremely challenging for institutions who want to comply, want to engage, to do that in the US today. Going back to the ETF piece, one of the topics at the previous conferences have been around the potential for a spot Bitcoin ETF. Obviously, the SEC have thus far denied those. The only ones they've approved have been based on cash-settled, financially settled futures. Do you see any change in that? Is that going to happen anytime soon, given what we've just discussed? And how much impact could that have for institutional adoption and I guess the Bitcoin price overall?
I'm like, no chance. I think even if the SEC loses a grayscale litigation, they'll just drag their feet, appeal. So I just don't see that in the next year and a half. I think you can, if you read the headlines and you really focus on the ETF industry, a couple of firms filed for Ethereum futures, ETPs in the last couple of weeks, and we call the SEC because obviously we'd like to do that as well. And they're like, we're gonna basically take a legal action if you file to make you pull your filing. So if you're like, why didn't VanEck file for an Ethereum ETF? That's why. And so they go after the bigger firms. They've pulled their filings yesterday as well. But it doesn't mean that the small firm won't continue to do it, or firms will continue to do it. But the SEC will drag their feet and try to do everything not to let that come to light. And they have so many regulatory tools that it's not a fair gunfight.
Totally agreed, but I do think the light at the end of the tunnel is that in a world where liquidity can move more freely between swaps, spot physical, futures, I think that the idea of futures-based ETFs can be more viable. Right now they've hit the ceiling, right? Because the futures market is too small. We're doing some things to address that right now, but if you look at, I think energy ETFs are kind of a good example of that, where most energy ETFs, they're based on natural gas futures and crude oil futures. If you look at the crude oil futures market, something like 1% of that goes to delivery. It's all paper trading. However, it's kept in check because these price differences between the derivatives market and the physical market get arbitraged like market makers like ourselves. So there is a mechanism that keeps them tight. So I think there is a future where the futures, no pun intended, the futures ETFs are a little bit more viable.
I also strongly feel that a spot Bitcoin ETF is really more symbolic than it will be like this huge, massive economic success. I think even if you look at GBTC, the amount of money that, cash, fiat, that actually invested in these funds, in Europe too, where we're a sponsor to buy access to Bitcoin and other tokens, is small. It's small. It's in the single, billions, compared to like this year alone, 60 billion went into government bond ETFs, like in the size of the, so I think most people went to Coinbase, right? However many tens of millions of people went there. They did not, access it through an exchange-traded fund. I want them to be approved, right? And we have a futures-based one, but I don't think it's sort of the economic success that some people think it will be.
We are bang on time, so I'd like to thank Jan and Eric for great insight into the institutional world and what we're seeing happen in the aftermath of FTX. So please thank Jan and Eric for joining us
Thanks.
today.
Thank you.
Welcome back. I'm Pete Rizzo, editor of Bitcoin Magazine. We're here at the Bitcoin Magazine live desk presented by Marathon, and I'm joined once again by special guests Joe Hall, reporter at Cointelegraph, Ansel Linder, host of the Bitcoin and Markets podcast, and Martel Fox, founder of Layer 4 Talent. We just heard from VanEck, StoneX, asset managers managing millions, ETNs. We heard about ETFs, portfolios. These are people who are advising, the regulators on how to approach our industry. I want to start with a subject that we didn't touch on in our opening, self-custody, and they talked about how they think it's a big part of the future. Institutions traditionally have not held their own keys, had their own custody. They talked about a non-exchange world. We don't need exchanges. What does that look like? Martel, maybe start us off.
Yeah, I think, I'm excited that there's a lot of new products coming, and they mentioned in the panel that things should be easier to use. So one company I'm super excited about is Satoshi. It's by second-time founders Dallas Rushing and Chris Hunter. It's going to be the app for everyone, where you could even send your mother to learn about Bitcoin. So I think as the industry matures, we'll see a maturity of the technology that we use, and that's very exciting. And yes, self-custody will be a big part of it.
And Joe, you use Bitcoin all the time. You're tweeting videos, spending it. How do we make it easier? Is it easy today? What do you think about their assessment of the state of the technology?
I didn't know you were a fan. Thanks, mate.
I'm liking and retweeting.
Oh, thanks, buddy. Yeah, so peer-to-peer, Bitcoin is peer-to-peer cash, right? That's what it said on the white paper. And today we see Bitcoin used as sort of this third-party thing, centralized exchanges, which you buy from. If you're clever enough, you might withdraw it from that exchange and hold it yourself. But I think the means in which we access, Bitcoin nowadays should be. I hope there's going to be a wave and a switch towards peer-to-peer. But in order to get there, we need it to be convenient. We need it to be easy. And I think that's what the panel was sort of touching on there. Is that we've seen the collapse of these custodians like FTX. Is there now an opportunity for there to be more decentralized protocols, decentralized solutions to access Bitcoin? And could that mean a peer-to-peer economy in the future? I hope so, and that's what my content tries to illustrate as well.
Ansel, institutions talking about self-custody. Is this a change?
It is, and I'll quote from Jack Mallers, demand finds supply. So all of this stuff with FTX, all these exchanges blowing up, there's going to be more and more attention onto self-custody, and that will bring the demand for businesses to provide that solution.
So we also heard about how hard it is to get in banking in the United States right now. We talked earlier about Operation Choke Point 2.0, Bitcoin companies being debanked. We heard a few things in that panel. VanEck coming out saying Europe could be the big winner. They talked about states competing for Bitcoin companies. Thoughts from the panel?
Yeah, well, it's kind of ironic. I just moved back to the U.S. I went over to Europe in about 2014. I think moving abroad is a great way to gain perspective, but I think America is still an incredible country, and there's a lot of hope still here. And the grass is green where you water it. So it's a great place to build a business. And, with remote work, I think if you're in the Bitcoin community and you can't leave America and you're here, maybe you can lean into the sovereignty. And I know you live in a countryside, rural area. So I think, if things are stressing you out in America, maybe go find some nature and you'll feel a lot better.
Joe, Europe, the big winner, obviously, your home turf. Your thoughts?
Yeah, yes, but every time I come to America, I'm always blown away by the wealth here. You come from Europe, which is obviously very historical. There's great taste and style and that sort of thing. But then you come to the US and you see the skyscrapers, you see the wealth. We're here in Miami, where everywhere you look, it feels like there are supercars. We talk a lot about de-dollarization in the US, the fact that people are leaving the US. But you come here and you're always struck by it. So I think there's a long time to go before we see a mass exodus.
Okay, Ansel, your thoughts?
I think the questions around regulation, I mean, we have to split it between crypto and Bitcoin. I think there's a lot less, or there's a lot more clarity around Bitcoin than crypto. These guys have some crypto interest, and so they're really looking for that clarity. But I think there is clarity with Bitcoin, just not so much with certain business models.
We're going to throw it back to the main stage. We've got coming up the Fed versus the financial system, moderated by Bitcoin Magazine Pro analyst Dylan LeClaire. We'll be coming back more in a minute.
All right. Okay, we got a cool panel. I'm excited about this next one. It's going to be awesome. It's called The Fed versus the Financial System, or as I like to say, the tyrants versus the free people. Anybody know what kind of car people at the Federal Reserve drive? Fiat. And anybody know what kind of medicine you take if you're going to sue the Fed? Sudafed. So this is going to be a great panel. It's all about one of the main themes of this conference, freedom of the people versus the centralized bureaucrats in fancy offices paid for by money they stole from the people. So we've got a wonderful panel, Fed versus financial system. Ram Aluaya, the CEO of Lumida. Mark Connors, head of research at 3IQ. Caitlin Long, who's an old friend of mine, American Banker Innovator of the Year nominee and CEO of Custodia Bank. And Dylan LeClaire, head of market research at Bitcoin Magazine. Thank you, folks. Let's give them a big hand.
Check, 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 check. Woo-woo. Hey guys, thanks for coming. Thanks for being here. Exciting times, Bitcoin 2023. For anyone that's a first Bitcoin conference, welcome. We got a great panel lined up today. Fed versus the financial system. Notice how it's not Fed and the financial system. It's Fed versus the financial system. So before we begin, I'm just going to let all the panelists kind of give themselves a little bit of an intro about their careers, their background, and why they're very, very much experts in this field. Caitlin.
TradFi to Bitcoin, been in Bitcoin for roughly 10 years, and I guess I'm taking some Sudafed.
Well played, well played. Mark Connors, TradFi obviously a little longer, less recently into Bitcoin, ergo the suit, so I'm migrating to orange sneakers eventually. Currently, I'm head of research at a digital asset manager, 3IQ, who pioneered the first spot Bitcoin fund and ETF in North America.
Hi, Ram Alawalia. I am the leader of Lumida. We're a private wealth advisor, provide tax and estate investment management, covering alternatives and Bitcoin. Prior to this, I was the CEO of the crypto business at Cross River, which has helped a number of institutions access crypto. We stand for decentralization and censorship resistance.
Cool. So I guess to start it off, here we are, 2023. We're almost 15 years post Great Financial Crisis, 3 years post money printer go burr, QE infinity. Now we're just basically on the tail end of the fastest rate tightening cycle ever. How did we get here? Let's just start from square one. Caitlin, you want to start, or maybe?